Do you know how to reduce your property taxes when you're buying a new homestead residence?
Hi Kirk, hi Dewayne. So thank you for another episode in your series of 60 lessons in 60 years. So today I'd like you to discuss the lesson on tax portability. What is tax portability?
So tax portability, it's part of the Save Our Homes benefit. That's the same benefit that only lets the home tax assessed value increase 3% per year. So what tax portability does is over the years, as you built up that equity of the home goes up in value, but your taxes can only go up 3%. You're building up equity over those years. So now what you're doing is you're taking that equity and you're transferring it to your new homestead property.
So in essence, if you had a property that you had a tax value of $350,000 say, and you were going to buy a $500,000 property, you could transfer that for $150,000. There's a cap of $500,000. So that's the max cap that you can do when you're transferring this portability.
Okay, well, will the homeowner still be able to file homestead and receive those benefits?
Yeah, you file for homestead exemption and then you file for tax portability at the same time. It's two different forms.
Now you can do it online, which is how he would do it, or you can do it like I would do it. And you go down there and you say, hey, can you help me fill out these two forms? And they'll do it. I mean, it's crucial that you fill out both these forms to get the portability though.
Okay, what would you say are the most common mistakes that people make regarding property taxes?
Forgetting to file your homestead or not even knowing about the tax portability. So like when we're using local lenders like a Bobby Dyer or someone that's a advocate for tax portability, they're actually sending a letter and reminding the homeowner to go down, file for homestead, and take advantage of the tax portability benefit.
And she'll remind you about that. Now, what I would tell you is when you get that deed from the title company or from the lawyer's office, go down and do it right then. Don't wait until February 28th because everybody else has waited and the line is huge. So go down there the minute you get your deed and get it filed, get it done.
Because you only have till March 1st?
You have till March 1st.
Okay. Is there a way that you can calculate for a customer this prior to someone buying a new property? Yeah,
I mean, we're gonna provide a link on the bottom of this video that will show you exactly how to do it. I mean, Dwayne's gonna do that. So I mean, I think that's the best way. You've got to follow the directions. It's important to do that.
You can come close. So for example, just for easy arithmetic, if you have a $400,000 just market value of your property, and your assessed value is $300,000, you have built up $100,000 worth of equity. It's really easy to calculate when you're buying a higher priced property. So let's say you're buying a property for $500,000. Now that has a just market value of $500,000. Now your assessed value is going to be $400,000. So it's really easy math whenever you're buying a property greater in value. When you're downsizing or buying a property less in value, there's going to be it's going to be a percentage of that equity, and we're happy to calculate that for you.
All right. Well, everyone loves to save money, so this is going to be very helpful. Thank you both for your time today.
Thanks for watching. Join us next week for our lesson. We talk about the importance of always evolving.